Earnings season is heating up. This week we've got some big names reporting, including Netflix and Tesla, but this is really just the warm-up. Next week things get very serious. We have SoFi, UNH, Meta, Microsoft, Google, and Apple all stepping up to the plate. But here's the thing, we are starting to see some warning signs in the market. Valuations right now are sitting well above levels seen during the dot-com bubble, and tech stocks just saw over $10 billion in inflows, the largest in more than a decade. ETFs have also exploded with over $1 trillion in inflows for the second year in a row, the highest on record, and we also can see that leveraged ETF exposure is at a record high of more than 700 funds. And investor sentiment, well, it is still shaky. Even with markets hovering near all-time highs, the mood continues to swing between fear and extreme fear, and October hasn't been that kind on the market overall. There is plenty of red in the S&P 500. Now, this shouldn't surprise anyone with valuations, as we've said time and time again, flashing bright red. And today's video, we're looking at a closer look at 5 stocks that could fall during earnings because, quite frankly, they look overinflated. Now, we're covering stocks that don't look undervalued, so not Novo Nordisk. And what we mean by undervalued or potential undervaluation is where the company, as we can note, for example, NVO, forward P14, well below the historical 30, as well as a yield of 3.2, well above the 5-year of 1.4. These would be 2 potential undervaluation signals, with the third reinforcement would be looking at the blue tunnel, which does highlight the expected intrinsic price. What we're seeing for a company like NVO is the expected price increase over time, but actually the share price decrease. Disparity very large between the bottom of the intrinsic value and the current price today. This is what we would say potential severe undervaluation. So let's look at 5 that aren't showing these signals, that are reporting their earnings soon. And the first one is Walmart. This is up 33% in the last year. Year to date, it's up nearly 20%. And over the last 10 years, this one has massively outperformed the S&P, up 454%. It's also trading very near to 52-week and all-time highs. Wall Street are the only ones with an indicator of a buy. In fact, they say strong buy, with Seeking Alpha and Quant giving this a hold. And with each one of these 5s, we will put it through our own valuation model. Well, on a forward P, it's trading at 39. Now, forget that it's significantly above the 5-year of 25, but for a company, as we're about to show you, that doesn't have that much growth, this in pure isolation looks ridiculously high. Add together, the 5-year average is much lower at 25, and the fact the yield today of 0.9% is well below the historical 1.5 does definitely give you something to consider. And the blue tunnel, as we can see, not only above, so opposite to what we saw with NVO, but massive disparity on this end. Again, this could be potentially severe overvaluation, something noted over the last 12 months for Walmart stock. And in fact, if you wanted this reasonably valued, well, you would go far back to mid-2024. One thing we would say though is this one only once in the last 5 years became undervalued around mid-2022. And if we zoom out even further, well, over the last 10 years, this one very rarely trades at a discount, meaning the market either sees this at a reasonable price or in fact lets it trade at a premium. And sticking with valuation, what makes it even more fascinating is that it now trades at a higher EV to EBIT than Nvidia. Definitely a bit of a head scratcher. And we also want to flag against the sector overall is trading at a 156% premium against their own 5-year, as we pointed out, a 53% premium, and price to earnings growth 5.3, 91% above the sector, and even against their own 5-year, which in isolation looks high, a 45% premium. And we can also note, looking back at the last 5 years, this one's growth comparable sales in the US, we are talking around the inflationary point in just the last few years, which is around 4%, so that is just to keep up in line with inflation. Most recent quarter, it was up 5%, and bear that in mind with the price or the valuation you are paying today. And and we get a C on growth where last year they grew top line 4%, expected 5% this year. Yes, it is a little bit above the sector, but just look at the last 5 years, it's pretty much in line, telling us Walmart really only grows its top line in line with inflation. Earnings per share not looking massively better, projected 7 to 8% growth in the next 3 to 5 years, little bit above the sector, but pretty much in line with their historical. And in their latest earnings, they actually missed the target from what analysts wanted to see, and they did put some of this down to tariffs pushing prices higher. One thing we will say, as we'll come to point out, their margins are very low, so if they are being squeezed, they'll either have to increase their prices, which may put customers away, or take the hit themselves and reduce their profitability. And in fact, as the largest private employer in the US, another thing they're looking to do is increase their wages. That is again something that will put a lot of pressure on their profitability. And during Liberation Day, probably no surprises, but they were saying they're going to look to increase their prices of their products, something, as we said, they're not going to take the hit themselves, so we believe will reduce their top line. We expect their sales to reduce as customers either buy less of their products or move to cheaper alternatives. And we can just flag that latest earnings, revenue was up 5%. We saw no efficiencies to their gross profit, in fact a 1 percentage point drop to their operating profit, which is at a 4% margin, and their bottom line 1 percentage point increase, but we can see these margins are in fact very low. Yes, similar to the industry as a whole, but this is something we need to bear in mind if they are going to increase their prices. On a positive though, their e-commerce and advertising were up strong double digit. That is something they will look to take advantage of, and maybe we will see the continued growth into quarter 3. And as we said, they did miss their most recent earnings, although they have a 75% track record, 3 out of 4 beats. Moving forwards into the next 4 quarters, 3 of them they're expecting double digit, Q3 3.5%, and if you do want to see this, earnings per share into next full accounting period just under $3 will lower the forward P to 37, which still for the company, the growth and everything in between does look quite costly. The final thing before jumping into our valuation, institutions own 27%. They sold in fact 22 billion worth of shares in the last year. They bought more than twice as much for Walmart at 51 billion. However, in the most recent quarter, we have seen institutions become net sellers, selling twice as much as they have in fact been buying, which leads us onto our intrinsic value at $85. Now, it is the average of the 3 models that you see on screen. We won't waste too much time going to each one. The only thing we want to flag, because for some companies we do solely use a DCF, if that is what you like, well, for Walmart, we get to $68. Bear in mind, we are using a growth rate of 15%, which already looks way too high. And more importantly than that, baked in today, as highlighted by the reverse DCF, if you're buying this, is 21.2% growth to the future free cash flow moving forwards. So whether you use a low, medium or high, each one does indicate downside, but for today and for Walmart, we've combined it with 2 other models, $85, meaning given the current price does sit higher, you're not getting a margin of safety. Now typically we'd kick off with 10%, we'd execute buy if it met the 3 golden criteria, wide moat, strong financial metrics, good forward-looking data. Well, if you believe that, a buy at $76, at 20%, a buy at $68, and at 25%, a buy at $64. However, what all of this is really insinuating is that today, given the valuation, you are paying a 27% premium. Is it worth it for Walmart? Well, let us know. Wall Street themselves, even the only analyst with a strong buy, see 115 into next year. That is 16% upside. So stock number 1, Walmart, let us know, is it a buy, hold or complete avoid? Before we move on to the next stock, just to let you know, we have released our latest free weekly article yesterday. Now we send one every single Sunday morning to your inbox completely for free, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of October. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're looking at is Starbucks, which is down 10% in the last year, year to date down 6%. Over the last 10, this one at one point had been outperforming the S&P, now only up 36% in this period. All-time high where you'd have to go to July 2021, more than 4 years ago, trading at $126. As of today, trading near its 52-week low, massive distance away from 52-week high of 117, and we get a hold from Quant. Even with a buy from Wall Street, that is very weak. 3.5 is what flips it from a hold to a buy. Seeking alpha with a 2.4 out of 5, giving it a sell rating. And on valuation, well, 35, well above the historical 29 average, which again in isolation looks very high, similar to what we said with Walmart. Yield is higher though, 2.9 above historical 2.3, and no surprises, overvaluation signal is what we get. Not only is it above the upper end, but intrinsically it has been decreasing, not a thing you want to note from any company you're investing in. And zooming out to the last 5 years, well look, the intrinsic price has not been increasing over time. It is a bit of a roller coaster ride, and the stock price today, as we highlighted, sits above. Bit of a red flag indicator, and it's trading at a 128% premium to the sector, 27% premium to the 5-year average. If you wanted a PG basis, well, 16.6, 861% premium to the sector, 475% premium to their 5-year. And we can see their comparable sales not only decreasing over the last 4 years, but over the last few quarters, in fact going as far back to March 2024, each one has been negative. Not a great sign whatsoever. -2 in the most recent, and their growth doesn't look impressive. Not even 1% last year, below inflation at 2.6 expected this year. On both accounts, below the sector, well below their high single digit from the past. Earnings per share, very, very poor, 2.4% over the next 3 to 5, well below both sector and their own historical in the double-digit space. And you know, things start to get a little bit questionable when a company like Starbucks does start talking about AI. Something, in fact, the CEO has said they're going to go all into artificial intelligence, and they're using it for a wide variety of things. One thing here on inventory counting, and they're hoping all of this will lead to a better experience for the customer. But as we said, is this now a case where when companies like Starbucks start talking about AI, it does start to make you question whether we're in an AI bubble? And if we do look at their most recent earnings, well, on a comparable basis, global sales were down 1%, North America, US down 1 and 2 respectively. The only growth that was really saw was international, up 2%. China was in fact flat. You know we don't like to see this. Margins were down 450 basis points year on year. Earnings per share down -38%. But what they have been doing is increasing their stores. Definitely not something we would say they should be focusing on. If sales overall are falling, people entering the stores are decreasing, then what is the point in increasing your costs having additional stores when consumers aren't in fact getting in the first place? Earnings also shocking. 3 of the last 4 were misses, also the last 2. Next quarter, a drop of 30% projected on EPS, with growth not seen to the 3rd and 4th double digit, but we have to see whether they can execute on this. And next full accounting period, still very high, forward P estimated drop to 32.4. And we note institutions with their 72% ownership selling $10 billion in the last year. They did buy more, around 70 to 80%, but in the most recent quarter, they have again been net sellers like we saw from Walmart, 137 million sales versus 20 million buys. In our intrinsic price, $75, again the average of the 3, which is always you can grab a copy by clicking on the pinned comment below, running through your numbers, whether it's for Starbucks or any others. But on a DCF, only marginally higher at 77, where baked in today is 8.4%. Moving forwards, we have gone lower for our own growth rate at 7%, but this is flagging again, like Walmart, no margin of safety, you are paying a 13% premium. 10% MOS would be a buy at 68, at 20 a buy at 60, and at 25 $56. Wall Street themselves see $101 into next year, 19% upside. So actually they do believe this is one to consider, but let us know where you see this on the spectrum of buy, hold or sell. The next one we're moving on to is Apple, up 9% in the last year, pretty much flat year to date. Over the last 10 though, it has been outperforming, up 747%, trading pretty much right there near its all-time highs of $260. Hold from Seeker Alpha, hold from Quant, weak buy rating from Wall Street at 3.9 out of 5, and another high valuation, especially given this company's growth projections. 33 forward P, above historical 28. Yield, although this isn't really a massively dividend paying company, but 0.4 below historical 0.6, and we get that overvaluation signal. It is sitting above the upper end, something also noted in the last year, meaning look, investors do in fact pay a premium for Apple overall, something that when we zoom out to the last 5 years, continually investors really do like this company. They do pay a premium, very, very rarely, a little bit in 2023 and Liberation Day, do investors get the opportunity to buy this undervalued, a conclusion that holds true when we zoom out to the last 10 years. And valuation at an F, 36% premium to the sector, 20% premium to their 5-year, price to earnings growth 3.4, not only a 90% premium to the sector, but look at their 5-year average, you're paying a 29% premium. 2.64 may not be too bad to consider for a company like Apple maybe in the past, but today 3.41 does look very, very high. And it's always that question about what is the next big thing that Apple are going to produce, because it looks like even the more recent things have been flops. That is what we are seeing, at least in the numbers. And Meta CEO has also said it himself, he doesn't believe they have invented anything great in quite some time, and that is something that I do personally also have to agree with. And we can also note here, did Apple just lose the face computer race to Meta? Well, in fact, they've reportedly shelved their plans to make a lighter, cheaper version of the Vision Pro goggles. Now, let me know whether you thought this was a success. Maybe you've used the product, maybe you've bought it, maybe in fact you've given it back. But this isn't something we're hearing about, at least in the last few months. And it looks like they're going to be focused on the glasses very similar to the ones that Meta are doing, that do seem, at least in this point, to be popular. But we're also hearing some contradictory things as well, that Vision Pro is something Apple are still looking to pursue, make it in fact a lot better so consumers have this as a must-buy product. Again, let us know your views on the Vision Pro. And if we look at one of the staples for Apple, which is their iPhone, in fact, very, very mediocre growth over the last 5 years. Most recent quarter took quite a lot of analysts by surprise, up 13%. Maybe we see this next week when they report, but their growth does look fairly reasonably rated here at a D. 6% last year, 5% expected this year, below the sector median, and in fact below their 5-year average. Not a good look for Apple. Earnings per share also pretty poor, projected 10%, that is below both sector and their historical. And in their most recent earnings, revenue was up 10%. As we highlighted, iPhone was a fast grower at 13, alongside the Mac at 15. In fact, the iPad and the AirPods and the Watch, which are grouped, were down 9%. Services also an area that they are looking to increase. Pretty hefty revenue, $27 billion, the second highest after the iPhone. Also worth noting though, no efficiencies noted to gross or operating or in fact bottom line. But they are looking green right across the board. In fact, over the last 4, they've outperformed fairly marginally, with some very low percentages that you would expect from this company expected into the next 4 quarters, with the September 26 forward P still looking high, dropping to 31.5, and institutions with their 68% ownership selling $160 billion. They bought twice as much in the same time frame. Although we also note, unlike the previous 2, institutions have also been net buyers in Q3. If you wanted the reverse of the trend, well, you would have to go Q1 2024. In our valuation at $200 sometimes does get a little bit of stick. Now we use the DCF, but what we've done is a growth rate of 8%. Now last year was 9, but on average it sits at 7. And if you're buying today, well, baked in is 11.4. No matter which number you use here, you can in fact see whether it's downside or upside. It is very trivial, so not one that looks very appealing. And even using the lower rate, what we're saying is a premium is to be paid if you're buying today at 28%. If you're looking at 10% MOS, a buy at 180, at 20, a buy at 160, and 25 around $150. Wall Street also don't see much upside to 60 into next year. That is only 2%. And if you believe we're being way too conservative, well look, at 10% still a premium, around 11% to be paid. If you believe 12%, which in this current climate does look a little bit unreasonable, whilst you're getting an MOS, it is fairly trivial, around 4%. But let us know your views on Apple today. The next stock we're moving on to is Hershey, up 2% in the last year, up 11% year to date. Over the last 10 years, up 96. This is on a downward trend from the last 2 years, where it was trading at $275, although it is moving quite some way away from its 52-week low at $140. Nonetheless, a triple hold right across the board, where forward P, again like the first two stocks, very high at 33, well above their 5-year average of 25, looks to be an overvalued signal. Yield 2.9, above the 5-year at 2.1, but the conclusion is, as we would expect, you are paying a premium. It does look to be overvalued, well above in fact the upper end of the intrinsic price, something noted for the majority of 2025. And if we zoom out to the last 5 years, well, we can see pretty much from its all-time high, also the intrinsic and fair value has been decreasing. Otherwise, this one for quite periods has been trading at a premium overall, and the valuation of a D meaning you're paying a 96% premium to the sector, 28% premium to their 5-year average. Not a good look whatsoever. And one thing they've had to do, which probably has really not helped their top line, is increase their prices, one that has faced some issues with rising cocoa prices, and tariffs also isn't something that would have helped. Their most recent quarter highlighted 5% growth to their products overall, and their growth very poor, 2.5% over the last year, expected the same this year, pretty much in line with the sector. What makes it disappointing is that over the last 5 years, they've been growing their revenue slightly higher, at least above inflation, and they're expecting no growth to the EPS over the next 3 to 5 years, with the sector and their historical around the 5 to 6% mark. And they also revised their 2025 outlook. Whilst they said net sales growth in the previous guidance up at least 2%, that is what they are maintaining. The thing here is that the reported earnings per share growth, whilst they previously said down high 40%, they're now saying down around 50, and adjusted EPS, again, not good, down mid 30, now revised to down 36 to 38. And even though they've beaten in the last 3 quarters, giving them a 75% track record, the next 3 they're expecting double-digit decrease to the EPS, and in fact the fourth one pretty much flat, meaning even with EPS growth into 2026, we can see the forward P still looking high at 28, and we note 58% institutional ownership, $3 billion worth of selling, a little bit more in terms of the buys, but they have been net sellers institutions in Q3, 168 million sales versus 17 million buys. In our intrinsic price, $175, the average of these 3, as we typically do. DCF 205, you can see baked in today is around 5% moving forwards. We've used a little bit higher at 6, but ultimately when we incorporate all 3, you are now paying an 8% premium. If you want a 10% MOS, buy at 157, at 20 around 140, which was its 52-week low, at 25 131, and triple hold right across the board. Wall Street see 190 into next year. That is only 1% upside. And then we move into the tobacco industry with Altria Group up 31% over the last year, up 24 year to date. Over the last 10, it is up only 7%. But if we actually look, this is the highest price the company has been, dating all the way back to 2018, and currently sits near its 52-week high. We only get a weak buy rating from Seek Alpha with the double hold from Wall Street and Quant, and the forward P of 12, whilst in isolation may not be high, we'll cover the growth shortly, is above their 5-year average of 10, and the yield you're getting today, 6.5, is below historical 8, but we should flag their dividend safety does come in at 55, borderline safe, which may be something to consider. And ultimately, this is largely driven from their free cash flow payout. We want to see around below 85% for this industry, and that is what we are getting for the company. Expected a slight increase to 82%, but again, something just to put on your radar, which then when we move to the blue tunnel, we can see quite consistently over the last year, it has spent a lot of time in overvaluation, something that actually when we zoom out to the last 5 years wasn't the case. Again, quite importantly, expected intrinsic price is on a downward trend, and in the most recent quarter their revenue was down. Main reason for this, less and less people are taking up smoking or continuing to smoke, and that's also seen in the cigarette volume. If you just look at that on a compounded annual growth rate, it's been decreasing 5.3% dating back to 2012. The valuation though does come in at an A-. You're getting a 26% discount to the sector, but actually a 22% premium to their 5-year. Price to earnings growth sitting at 3, 9% premium to the sector, but 38% premium to their historical. And their growth at a D, no surprises, flat year on year. Remember, factoring inflation, that is down in real terms. Over the next year, flat again, below the sector and even below their own historical, which only really sits at 1%. In terms of earnings per share, projected growth around 4, below sector at 6, and not far off their historical 4.6. We're great to see green across the board, 100% track record in the last year, expecting growth although low single digit to the EPS, and forward PE only expected drop very marginally to 11.6 into 2026, where institutions with their 57% ownership sold $4 billion in the last year, bought twice as much, but they sold nearly twice as much in Q3, highlighting they are net sellers. And our intrinsic price comes to $61 today, where on a DCF it does come low at 56. Baked in though is pretty much no growth to their future free cash flow moving forward. We have gone though negative 2%, and this in turn does mean you're paying a 6% premium today. Now 10% MOS, a buy at 55, at 20, a buy at 49, at 25, a buy at 46. Wall Street see a drop into next year, $64 target, downside of 2%, but let us know your views on Ultra today. Is it a buy, hold, or complete avoid? And don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.